Your savings account grows every month. The number gets bigger. You feel responsible and disciplined. But what if that growing number is actually dead capital slowly losing power? What if the money you're protecting is quietly dying? Everyone knows the formula. Work hard, spend less than you earn, save the difference. Banks encourage it. Parents repeat it. Financial advisors build entire careers around it. The message is everywhere. Accumulate money, protect it, watch it grow. But there's something that doesn't quite add up. Why do the most disciplined savers rarely become truly wealthy? Most people think saving creates wealth. Put money in the bank, wait patiently, let compound interest work. This sounds logical because every institution tells you this is how normal people build security. But there's something curious about how wealth actually works in practice. Why would ancient merchants who understood money better than anyone refuse to save? The answer reveals the first layer of deception. Money was never meant to be wealth. Money was always meant to be a placeholder for wealth. Actual wealth throughout history came from ownership of productive things. Land that grows crops, ships that carry goods, workshops that produce tools. Money sitting still was considered wasteful, even dangerous. This pattern repeats across every civilization that built lasting prosperity. If you want to see how capital actually creates wealth versus slowly dies, subscribe to Prof. Jung Explained. Understanding the difference between seed capital and dead capital changes everything. Think about ancient Mesopotamian merchants 5,000 years ago. They didn't hide silver in vaults hoping it would multiply. They formed partnerships to fund trading expeditions across dangerous territories. Some caravans never returned. Bandits attacked. Storms destroyed goods. But successful expeditions returned with profits that dwarfed any savings account. The principle was brutally simple. Money must move to multiply. Stillness equals slow death. Every month, money sits idle. Inflation erodes purchasing power. Economic conditions shift. New opportunities emerge and disappear. The saver believes they're building security, but they're actually choosing the slowest possible form of wealth decay. But here's where it gets interesting. This isn't about recklessness versus caution. It's about understanding what money actually is. Money is not wealth. Money is a claim on future wealth. And claims sitting in savings accounts slowly lose their power to claim anything meaningful. Consider how medieval European merchants operated. They organized into guilds and trading companies. Each merchant contributed capital to fund ships sailing to distant ports. The Mediterranean trade, the Hanseatic League, the Venetian trading empire. None of these fortunes came from saving. They came from deploying capital into moving systems. The ships themselves were seed capital, money transformed into wood, sails, and cargo. That seed sailed across dangerous waters. Many seeds sank. Pirates captured vessels. Storms destroyed entire fleets. But the seeds that reached port and returned multiplied initial investment by factors of 5, 10, sometimes 20. This creates what economists might call the movement premium. Stillness preserves capital at the cost of opportunity. Movement risks capital for the possibility of multiplication. Throughout history, every major fortune chose movement over stillness. Because stillness is just slow motion loss disguised as safety, the system becomes even more sophisticated when we examine compound growth. Everyone knows the formula for compound interest. Principal times rate raised to time period. It sounds powerful in theory. But theory assumes the interest rate exceeds inflation, taxes, and opportunity cost. In practice, savings accounts rarely win that race. Meanwhile, productive assets compound differently. A business that reinvests profits doesn't just add percentage points annually. It expands capacity, enters new markets, develops new products. Compounding happens across multiple dimensions simultaneously. This multi-dimensional growth creates exponential trajectories that linear savings can never match. Think about the Industrial Revolution. Fortunes emerged not from people who saved wages from factory work. Fortunes came from people who pooled capital to build the factories. The factory owner deployed seed capital. The worker accumulated dead capital. Both started with money. Only one transformed that money into expanding systems. But perhaps the most sophisticated aspect is how dead capital creates psychological traps. Watching savings grow feels productive. Each month, the number increases. You feel disciplined. You feel responsible. This emotional reward reinforces the behavior even when the strategy fails to build actual wealth. The tragedy is how the system appears to regular people. They see savings accounts as building blocks. They believe patience and discipline will eventually carry them to prosperity. They follow the advice perfectly, yet the finish line keeps moving farther away. Not because they lack willpower, because they're playing the wrong game entirely. And perhaps most remarkably, the financial industry profits enormously from dead capital. Banks need deposits to fund their lending. The more people save in low-yield accounts, the more capital banks can deploy at higher returns. Savers provide cheap fuel for the financial system while receiving minimal benefit themselves. Consider how different the conversation would be if people understood seed capital. Instead of asking how much to save, they'd ask where to plant. Instead of celebrating account balances, they'd measure how many seeds they've deployed. Instead of fearing risk, they'd study which soil conditions enable growth. The seed capital mindset completely transforms financial strategy. Dead capital asks how to protect money. Seed capital asks where money can grow. Dead capital optimizes for safety. Seed capital optimizes for multiplication. Dead capital fears loss above all else. Seed capital accepts that some seeds fail, but surviving seeds transform landscapes. This explains something curious about how wealthy families operate across generations. They don't teach children to save. They teach children to recognize productive assets. The Rothschilds didn't build banking empires through savings accounts. They deployed capital into government bonds, mining operations, and infrastructure projects across continents. Rockefeller didn't become the richest American by accumulating cash. He continuously reinvested profits into expanding Standard Oil. Every dollar became a seed planted in refineries, pipelines, distribution networks. The business grew not through addition, but through multiplication. Each investment created capacity for more investment. Modern technology fortunes follow identical patterns. Bezos didn't save his way to wealth. Amazon's early years consumed cash relentlessly. Every dollar went into infrastructure, technology, market expansion. Dead capital would have preserved those dollars safely. Seed capital transformed them into global commerce infrastructure. But there's something even more insidious about the dead capital mentality. It creates what we might call opportunity blindness. People focused on preserving savings can't see productive deployment opportunities. The mental model is wrong. They see money as fragile object requiring protection. They should see money as tool requiring deployment. Think about what this means for entire economies. When populations hoard dead capital, economic velocity slows. Money circulates less. Fewer businesses start. Less innovation happens. Economic growth stagnates. Meanwhile, economies where capital moves freely generate more opportunities, more innovation, more widespread prosperity. The system also exploits what behavioral economists call loss aversion. Losses hurt psychologically more than equivalent gains feel good. This asymmetry makes people overweight preservation. They protect against visible losses while ignoring invisible opportunity costs. Dead capital feels safe. Seed capital feels risky, but safety is often the greater risk. Historical examples prove this repeatedly. Every major economic transformation required massive capital deployment into uncertain ventures. Railroads, electricity, automobiles, aviation, computing, internet. Each wave began with investors accepting huge risks. Many investments failed completely, but successful ones generated returns that made early savings look microscopic. The cruel irony is that avoiding risk often creates the greatest risk. Inflation silently erodes purchasing power. Economic conditions shift unpredictably. Job security evaporates. Industries disappear. Under these conditions, dead capital provides illusion of safety, while actual security comes from developing capacity to participate in value creation. Modern portfolio theory attempts to balance these dynamics. Diversification across asset classes. Some growth assets, some stable assets, some liquid cash. This sounds sophisticated, but even diversified portfolios must deploy capital into productive assets. The portfolio doesn't grow from holding cash. It grows from equity, real estate, bonds that fund economic activity. The challenge is that seed capital requires knowledge. You must understand what makes assets productive. You must evaluate opportunities. You must accept uncertainty. This demands more than discipline. It requires judgment, learning, and courage. Dead capital is simpler. Just accumulate and preserve. No judgment required. But simplicity has a cost. The cost is opportunity. The cost is growth. The cost is watching others build wealth through deployment while you build only slow-growing account balances. The numbers may look impressive, but compared to what was possible, they represent massive unrealized potential. Consider two people who each inherit $50,000. One deposits it in savings, earning minimal interest. The other uses it as seed capital for a small business or investment property. 20 years later, the saver has perhaps $70,000 after inflation barely kept pace. The planter might have hundreds of thousands or more. The difference isn't luck, it's understanding money's true nature. Money is not the destination. Money is the seed. Seeds locked in vaults stay safe but sterile. Seeds planted in productive soil face weather, pests, and uncertainty. Some seeds die, but surviving seeds become forests. This is why wealthy families teach their children to think like farmers, not like hoarders. Farmers understand that keeping all seeds in the barn guarantees no harvest. You must plant. You must accept that some seeds fail, but you also know that successful harvest multiplies what you planted. The financial education most people receive focuses entirely on the barn. Save consistently. Protect your money. Avoid risk. This creates generations of people who accumulate dead capital while wondering why wealth remains elusive. They followed every rule. They did everything right. But they were taught only half the game. Seed capital thinking changes the fundamental questions. Not how much did I save, but how many productive assets do I control? Not how safe is my money, but where can my money multiply? Not what percentage interest rate, but what growth rate can deployed capital achieve? Once you see this distinction, the world looks completely different. Everywhere you look, you see potential deployment opportunities. Businesses needing capital, technologies requiring development, real estate below replacement cost, ideas waiting for funding. The economy becomes a garden full of possible planting sites. The real question isn't whether saving is good or bad. Saving serves important purposes. It creates emergency buffers. It provides deployment capital when opportunities appear. But saving should never be the destination. It's only the beginning, the moment when enough seed accumulates to start planting. Hit subscribe if you want to understand how money actually multiplies versus slowly dies in plain sight. Share this with someone still treating their savings account like it's building wealth. The tragedy is that millions of hardworking people spend decades doing exactly what they were told. Save diligently, protect carefully, wait patiently. They follow the rules perfectly, but the rules were designed to benefit the system, not the individual. Banks profit from deposits. Employers prefer workers who prioritize security over entrepreneurship. Meanwhile, the people who build actual wealth understand the secret. Money sitting still is money dying. Money deployed into productive systems is money multiplying. The difference between dead capital and seed capital is the difference between preservation and transformation. One guards the past, the other builds the future.